for a closer look at currencies. I'm joined by Hans-Guenter Redeker. He's Global Head of Foreign Exchange Strategy at BNP Paribas here in London. Thank you so much for joining us. Now, we had high hopes from the IMF meeting, and it seems that these differences in terms of how you deal with these global imbalances, the talk about currency wars, well, they just weren't addressed. They weren't able to find common ground. What does it mean for currencies in the future?
Well, what it actually means is the continuation of the recent status quo. So when there's no agreement, then actually we are going to continue that the US is printing money and Asia is going to continue to keep its currency undervalued, which itself does require the print of money. So that means that financial markets are confronted with a wall of central bank liquidity. That central bank liquidity is looking for a destination. It wanted to be channeled in that environment where there is least of a resistance. Now, when
Hans-Guenter, if we go back, 2-3 years ago, before the financial crisis, I mean, I remember covering the G20 IMF meetings, and it was all about global imbalances. It was all about, China versus the US on how to deal with these global imbalances. And then it seems that this whole debate got hijacked by the financial crisis. So are we just going back to what we had pre-financial crisis?
Well, I guess you do not need to go as far as back far as that. And when you just look at what had been said by the Chinese central bank president as he was talking about the special drawing rights issue, which he debated about 18 months ago, which was again based on the idea that the US dollar would be no longer a sound currency. Now, I guess that this global imbalance story is going to dominate, and it comes on the back of the capital market deregulation we have seen over the past 20 years, which actually made capital to flow from one end of the world to another end of the world, and that helped as well to create imbalances, because we did see other parts of the global economy not being deregulated, and one of that was, of course, the development on the FX rate. Just take the announcement we have seen overnight from Thailand and Korea, when these two countries are saying that they wanted to introduce soft capital market restrictions to limit the inflow of capital, then that is another sign that they wanted to keep their exchange rates undervalued. So all in all...
Give me a little bit of an idea, actually, of where you expect the dollar to go, because we've seen it decline quite significantly over the last quarter, actually the most in 8 years. But some top investors are telling us they now expect a rally.
Well, I guess that we have to take this really into perspective. Our year-end forecast stays at 134. And the reason why we are relatively skeptical from current levels has a lot to do with that looking back into European developments. When you look, for example, that about 16 to 18% of German exports are going into China, and there the euro-renminbi exchange rate has appreciated quite a lot. People were talking about the German miracle, but was the German miracle borrowed from the Chinese miracle? That is a question, and I guess the answer to that is a positive one.
Hans-Guenter, thank you so much for that. Hans-Guenter Redeker there at BNP Paribas.